If you read the title of this video, you can probably tell what we're doing, but if not, we are going over the indicators that I use and why I use them. If you guys stay until the end of this video, I am going to give you guys an extra little bonus. It's not an indicator, but it's close enough. So without further ado, let's just jump straight into this video. So I want to start by clarifying that the indicators that I use them strictly for confluence, and you guys should use them for the same reason. Confluence and building confidence in your trade setup. Now, what that means is rather than just trading strictly based off of EMAs, you have to have some sort of back reasoning, such as like a breakout structure or some sort of setup for your trade before you go and add these indicators into it, because at the end of the day, indicators are confluence, and that is it. I just wanted to make that clear. Now, I'm going to go over the indicators that I use. I have tried so many different indicators. I've tried all of those like algorithmic indicators where it tells you to buy here, sell here. Those are, don't even get me started on those, okay? Let's just not talk about those. They don't work. They're not good. They're not consistent. They're not reliable. The ones that I have found that work, that are reliable, that are consistent, are those of which I'm about to explain right now. So we have Solana pulled up on the charts. We took a trade earlier. We took about 20% out of Solana. Wasn't what I was really hoping for, but I can't complain on 20%. Only took us like an hour. Anyhow, these are the indicators that I use. So we have Solana right here. I'm going to go over these in order, okay? So the first one is volume. Obviously, you guys can see the volume bars down here. I just want to specify that there is a big difference between when you're dealing with volume trading or volume-based indicators. A lot of people, there's a big common misconception that when you have a ton of volume come in, that means that the market's just going to pump or dump. And that's just simply not true, because of the fact that you can have, let's say, for example, a lot of volume. Like right now, Solana's averaging like 50,000 volume. Let's say Solana has this big volume pump or dump of 500 million, okay? A big 500 million wave of volume comes in. You could have 500 million buyers, and you could have another 500 million sellers. That's a billion in volume total. But if the same amount of people are buying and same amount of people are selling, depends on how much they're buying or selling, but that can literally make the market just go zero, go nowhere, stay where it is. So just wanted to clear up the misconception that volume just indicates if a price is going to go somewhere. That's just not always the case. But it can be, again, some sort of confluence to tell you that that might happen. Second, we're going to go into VWAP. Now, VWAP, you're going to see all these random lines here. VWAP, I like to trade in uptrends and downtrends, right? So this is how I find, and again, this is just confluence, but this is how it helps me find good chances and good reasoning that the market is going to either be in an uptrend or a downtrend. Now, typically, I ignore these green lines. That's like the safe zone. But this blue line here is VWAP. Now, if you're above VWAP, chances are what's going to happen? The market is going to go up. If you close below VWAP, keyword close. It's not just if you wick above it. It's if you fully close a candle above, then chances are you're going to go up. If you fully close a candle under VWAP, there's a good chance that the market is going to go down. Again, this is a very simplified version. If you guys want me to make individual breaking down each individual one in a different video, I will, but just for the sake of this video not being 45 minutes long, let's just keep it at that for now. EMAs, I only use 2 EMAs. You see this 50 EMA here, it's toggled off. I use it sometimes, not that frequently. These EMAs, the 9 EMA and the 200 EMA, are very important to me. This is kind of the same thing in terms of trends. Now, again, you have to be careful, because right now, we can see that this is the 9 EMA. It's blinking. I'm going to turn VWAP off. This is the 9 EMA here, this blue line, okay? And this is the 200 EMA, this purple line. I like to have them different colors. It's just a preference so I can tell which one's which. Now, when you have these crossing, okay, the 200 EMA, it's a moving average over a certain period of days, which is 200 days. So obviously, this isn't going to move as much as, let's say, the 9 EMA, right? So once you start to see this 9 EMA come up and cross above the 200 EMA, that is a good sign that you are going to be bullish, and this is probably going to continue upwards. Now, obviously, you have to have extra backbone to that structure, but that's just a good rule of thumb. Now, the reason why I say I only use this in uptrends or downtrends is because if you try to use this specific strategy with the 9 and 200 EMA, if you try to use it when the market's completely sideways like this, it's not going to work, because you're going to see the EMAs cross, right? Let's say it crosses right here and you go short here. Well, you're going to get what is this? You're going to get 0.2% out of that, and then you're probably just going to end up getting stopped out. You have to wait until there's an actual confirmation of a trend, such as this, for example, okay, big uptrend, and then we break that trend, boom, here's where it crosses over, here's where you get in short, and you print, okay? Fairly simple, all the way down to here even. So right now, we are kind of switching. We're going into an uptrend on the 15-minute time frame. So in this case, I would probably get into a trade here long, depending on some other factors that I would have to look at. I also have my no limit trades, supply and demand zones. This is pretty cool for not having to chart out all of the supply and demand zones. This is something I've considered giving out to people. I probably wouldn't charge money for it just because it's kind of simple. But it just uses the algorithm to chart out breakup structure, supply, demand, simple stuff like that. So if you guys want this, let's get 500 likes on the video, and I will give out this indicator for free. Then moving on, trauma, I'm not going to go over that. That's just something I use for crypto, which is what I mainly trade, but I don't use it a lot, and there's a very, very specific setup that you have to look for when you're using the trauma indicator. And then we have 2 more left here until we get to the little bonus that I want to show you guys. The first one of the 2 is going to be RSI, which is right here. Now, RSI is a very interesting indicator. This basically, you can see there's a level between 30 and 70. You can change this, but I would probably recommend keeping it between 30 and 70, and 50 is your middle ground here. Now, typically, in any instance, when RSI goes under this 30 level, as close as it can be to 0, most likely the market is oversold. There's not a lot of buyers. There's not enough buyers. And that means that, it's very likely that the market is going to reverse. Whenever you see these peaks where it's oversold, you almost always see a reversal there. So big peak, reversal, again, reversal, reversal. Almost every single time you see it peak out of this area, although at some times you might get caught up in chop, so you do want to be careful. Obviously, this is just confluence. So that's RSI. That's pretty much how I use it, just looking for those key levels. And then right down here, we have MACD. MACD could be a whole video in itself, and I actually did make a MACD indicator video. So if you guys want to check that out, that will be on my channel, and I'll try to link it up here if I possibly can. But anyhow, MACD is mainly just looking for squeezes in the market. Again, I'm not going to get too into it, but in simple terms, when you see this green squeeze start to come in, like here, for example, you go from red into a green squeeze. If these cross over under, blah, 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 these cross over above, you go short here, you go long here. There's a lot of different ways that you can use MACD, and it has to be set up in the proper way. But I'm not going to waste too much time just on MACD specifically, so let's go and turn this off as well. Now, the very last thing, my hidden gem, it's not really a hidden gem, but I like to use the Fibonacci retracement tool. It is not an indicator, but it is a tool, okay? It's not an indicator, it is a tool. Now, if we take, a lot of people kind of use it in different ways. Some people will take it from the bottom of the candle body, like this, for example, and take it to the top of the highest body here. But what I like to do is I like to go based off of the top and bottom wicks. So we will go from this bottom wick here, right down here, place it down there, and we'll drag it up to the very top wick, which is right here, this red candle. Now, when you set up the Fibonacci retracement tool like this, this is showing you good levels of potential support, even if there's not support there in the market. Again, the Fibonacci tool could be an entire video. But to make this in the shortest words that I possibly can, if you are in an uptrend, and this is the only time you can use the Fibonacci retracement is in an uptrend. If you try to use it in chop, like from here to here, it is practically pointless, okay? So I like to use it in an uptrend or a downtrend. Right now we're in an uptrend. You can see that from the top point here, actually from the top point here, we did bounce off of this 0.236 level multiple times. We see 1, 2, 3, these two closed, but they ended up coming back up, 4, 5, 6, 7, 8, 9 times just on this 0.236 level. That's showing a lot of support. So one of the ways that you can play this is you can wait for what you think might be the top, but I don't really recommend that because you're kind of just guessing where the top's going to be. You have a pullback, you get in at a certain level. What I like to do is I like to get in around this 0.382 level just because at that point you're going to know that you've probably reached your top. If you push up and just have a tiny pullback to the 0.236, that's a little less likely. But make sure if you guys are using the Fibonacci retracement tool, make sure that you guys are using the right levels. Now, these are the levels that I like to use. You can use whatever you learn or whatever you're comfortable with, but I mark off everything down here. I just keep from 0 to 1. So that's a cool little trick, cool little thing to know there with the Fibonacci retracement tool. It's a good tool to use. If you guys want a more in-depth video on any one of these specific indicators, let me know. I'm more than happy to make dedicated videos to all of these, but let me know in the comments down below what specific indicators you guys want to see. Or if you guys want me to just put it into an hour-long video, I can do that too. It's up to you guys, but hope you guys enjoyed this video. If you guys are new to the channel, if you don't already know, I run No Limit Trades. It is the best Discord in the world, undeniably. We have some crazy results every single day, and obviously all of these trade setups, using my indicators and using all of my information that I know, I alert those out into the Discord every single day for my premium members. We also have some free stuff in there. Pretty valuable information. Go check it out. Thank you guys for watching this video. I will see you guys in the next one. Peace out.